Good morning, good afternoon, good evening, wherever you are. Thank you for joining us for today's public webinar. As many of you know, or maybe some of you who are new may not know, we like to do these public webinars so you have awareness of what's happening in the market, Jim's take on it, as well as because we have a live market profile primer coming up from August 2nd to 10th. If you go to our website, jimdeltontrading.com/courses, at the top navigation, you'll see that the primer is featured up at the top. This is an 8-day live course for which it's a low price of entry to join us to check out how we teach, learn the basics of market profile. We will also be plotting the profile manually. For those of you who do not have market profile charts or don't want to pay for them, you can do it manually, or as I like to say, semi-manually. So that is an exercise that we will go through on the 4th day. It's a great review for those of you who want to just make sure you understand some of the foundational concepts as taught by Jim, as well as a great course for those of you who are new to market profile and trying to figure out, is this a rabbit hole that I want to jump down and spend more time and money on? So if you've got any questions, please feel free to call us at the number at the bottom of our website or shoot us an email at dalton@jimdeltontrading.com. Since this is a live course, all of the webinars will be recorded in case you're not able to attend one because maybe you have a day job or you're just out one day, or you just want to review. You will have access to materials for 3 months after the course finishes so that you have time to review. Anything else you'd like to add, Jim?
No, that's just great.
Okay, shall I give you the screen then?
Please.
Okay, one moment. Oh, just one more thing, just want to point out for those of you that are new, if you're looking for the timings of the schedule, you can go and download the PDF from our website. Times are posted in Eastern. Please adjust for your time zone. And I just wanted to mention that there are a lot of people that I know, they've got day jobs, they're not able to attend all of the classes live, and so that's another reason why we have them recorded for that purpose. Okay? Okay, Jim, let me give you the screen. There you go.
Okay. If we can start, would you put up last night's report? I'm going to walk through a report I did last night.
Oh, okay, 1 second. Let me get that back up on my screen and I will bring that up. 1 second, I'll take the screen back. Playing hockey here. Okay, can you see my screen?
Yes, I can.
Okay,
Okay.
great.
Notice it says a rarity on the over on the left of the report. This is quite different than any report we've ever done. The phenomenon that we are undergoing in the current market that's been underway for some period of time is something that you probably will only see every few years. When we're talking about daytime frame trading, most of the time we are talking about so much of daytime frame trading relies on inventory that gets too short, then you get a short covering rally. Inventory that gets too long, then you get a liquidation break. That is a kind of a constant that goes back and forth on short-term daytime frame trading. What happens in the day time frame when inventory gets too long and too short also happens in the longest of time frames. Now, this is a little bit complex for some people to understand. We have been talking, if you've listened to some of the weekend YouTube comments we make, or a couple of our webinars, we have been talking about the pain trade for some period of time. The possibility of a pain trade, we have probably been talking about it for 3 months. To understand the pain trade requires that you understand how long-term money managers are measured for performance. You and I, as short-term traders, we think in terms of actual performance. Are we Are we up or are we making money or are we losing money? Long-term money managers are measured on a relative basis. They're placed in each manager fits in some kind of peer group, and they are measured against other members of their peer group. Now, here comes the really difficult thing, and what we're talking about right now is at the heart of the pain trade that we've been talking about. And the pain trade has been what's been driving this market higher. You and I understand what it means to be short the market. The long-term money managers that are underinvested, if they're holding too much cash, because they are measured on a relative basis, if the market goes up and they're not fully invested and the peer group that they're in is more fully invested, that money manager his performance is going to look very similar to what would happen to you and I if we were caught short. This is complex, but if long-term money managers are not fully invested and the market goes up, they will underperform the market, just as you and I would underperform if we were short. The pain trade, what we have been saying for an extended period of time, it really starts, one of the things that I reflect upon is when Jamie Dimon came out, quite a while back and announced to the world that there would be a recession. I made a comment at the time, for 50 some years I've been trading. It is rare when something like that is announced ahead of time that it actually takes place. It's pretty hard to see that far ahead in the market. The other thing that happened was everybody came out and they talked about the inverted yield curve, and that the inverted yield curve leads to recessions. What they didn't talk about is how many times that generates a false positive. So what I think's happened, what we could see in the market was that the long-term money managers were underinvested. The hedge funds, from best information we have, were short. The retail traders were long, and the CTAs, or commodity trading advisors, who are very similar to retail trading, were also long. So we had this division in the market. The higher the market went, the more pressure that put on the longer term money managers that were either underinvested or invested in assets that were not aggressive enough, not enough growth orientation, were under substantial pressure. So what you have been witnessing here for some period of time, and now you're getting to the point where the pressure really started to come on, last week, once we got above the 4,500 level, that increased the pressure. So you're getting a tremendous amount of new buying by the longer term money managers that were underinvested. It's kind of forced buying. It's what we call the pain trade. In the pain trade, it's when the markets do what hurts and squeezes the greatest number of traders. So this is what I think we're witnessing right now.
Jim, do you want me to scroll down? Because we were on the monthly, which was the first page of the report. Since it's multiple pages,
Okay.
I wanted to go down so that people could see.
Okay.
So here it is on the daily bar.
Okay. Now, one of the things that you will find is that those that have been listening to market generated information have probably been somewhat confused or disappointed, because when we talk about weak underlying market structure, which includes the shape of the profile, includes poor or weak references, as well as gaps, there is a tremendous amount of weakness or weak structure underneath the market, yet the market continues to go higher. That is the short covering really is what causes that. Short covering happens all the time. It happens in the day time frame, quite often. It doesn't happen that often, as I'm saying, from the longer time frame. But what you're seeing, and I called this report a rarity, because that's what you're seeing going on right now. So it has been very difficult for people that look at market generated information, because they have a tendency to overweight smaller pieces of information and kind of underweight. The real value is value. Value's gone higher. Value is the number one key to this information. Trend, value have been higher. The underlying weaknesses are weak. So it makes a dichotomy in there. If you remember, when the market on the day time frame basis, a short covering rally can weaken a market. And the short covering rally can weaken a market. First of all, if the market is too short, it strengthens the market, because how do you cover a short? You have to buy. Once the short covering rally is completed, it weakens the market because it's removed that support that was in the market. The same thing occurs on the longer time frame. Like I say, this is a rarity. It doesn't happen very often, but clearly that's what's going on right now. And like I say, we've been talking about this for probably 3 or 4 months. Now it's really getting underway. When it's over, it can have the same effect of weakening the market, because it removes that potential buying power. But you don't want to jump the gun in the market. It's momentum is also going to be very strong, because momentum, it's price momentum. So you're in a position right now where you've got this upside breakout. Once you got above the 4,500 level, it really.
Jim, I just wanted to ask, was there a particular page you wanted to be on right now for the report? Since you're.
No, not really. I'm just, I'm just talking through it.
Okay, I'm sorry. I didn't want to interrupt your flow, but I just wanted to make sure.
No. I'm just giving a general overall feeling for people to understand the pain trade, understand what short covering means for the longest of time frames. Generally speaking, and this takes some understanding in the market. Generally speaking, people think of short covering as, well, you were short, you had to buy to cover. But short covering from a longer term time frame occurs or has the same effect if the longer term money was underinvested. And where I started out, these markets were underinvested a lot because people believed there was going to be a recession. They got, too taken in by the idea of the inverted yield curve without really looking to see that there's a lot of false positives in there. So where we are in this market right now is the market is, put a new high for, I think it was April. I think yesterday's high was the high since April of last year. You're just a little bit away from the, the next reference was up a little bit above the 4,600 level. So you're looking now, and you get ready for this morning. Remember, the trend is up. One of the most important things you'll ever do is look at the trend. And remember, don't fight the trend. Yesterday is the kind of day that hurts an awful lot of traders. A lot of times these markets keep going up because short-term traders, short into the market. most of the trade, one of the questions we ask when we start an educational program, how many people can do go with trades, meaning go with the move yesterday, versus how many people are constantly fading the moves. And my guess is that there's an awful lot of short-term traders that kept selling yesterday's market. When the markets, you don't fight these short covering rallies. So where are we as we're coming into today? You had no excess on yesterday's high. Excess is one of the most important things that we deal with. A lot of times traders get in trouble because they listen to financial news, and financial news as a trader it may be fine for investing, but financial news really doesn't cover when markets are too long or too short. I put out here the MGI information, which we talked about before, and a lot of people would consider the market generated information has been misleading to them because of all the poor underlying references, the weak highs or the weak lows in there. And that's true. And it's been a challenge for me because I'm so aware we have a tendency sometimes to overweight those smaller pieces of information. The bigger pieces of information are breakouts from balance and trend. Those are the biggest pieces of information. And the trend's been up, the breakout from balance, and the breakout from the 4,500 level, now it's testing the 4,600 level. That's where we are. The next thing I put on this report is fool me once. So the short covering rally, and remember, even on the longest time frame, once the short covering rally is over, it can have the effect of weakening the market. So be aware of that. Follow market generated information, follow the trend, follow the balance. Right now, when markets go up, they usually go trend to balance, which means they move sideways. They don't very seldom are V-shaped up or down. We did have one V-shaped recovery as the pandemic hit, and really that was because of how much money the government put in. But generally, markets go trend, balance, back to trend, balance, reverse. So right now, the trend is up. We're looking to see if the market will start to find some short-term balance. So for today, you're looking to see, do we get continuation? Overnight inventory, probably by this time, is pretty well balanced. We had no excess on yesterday's high, and you can see we're challenging yesterday's high. So the question is, do we get continuation today? Do we get balance? Do we get higher value? Notice the very prominent point of control from overnight. Jen, can we show the chart for a second? Show
Yes. Oh, you want me to give you the screen? You want to show your
Please.
chart?
Yeah, you show yours. That's okay. I just want to show the very prominent point of control.
You want to show yours, or you want me to show mine?
Show yours.
Okay. That's why I was like, I'm not sure what you want to do.
All right. So the overnight point of control is 22 ticks wide. The wider the point of control from overnight, the greater the odds it will be revisited. If it's not revisited, that's a sign that the market's continuing the strength. So as we get ready to open today, remember we had no excess on yesterday's high because there was no completion. Okay, let me go back and take a couple of questions in here.
Okay, I'll give you the charts then. I'll give you the screen. Do you want me to give you the screen, Jim?
Yes, please.
Okay. I've given you the screen.
Thank you.
Okay, so we had a question here, and I'm going to try to give you the interpretation of what I think this person was asking, but the original question was, did you consider the price spike and spike base as two different nuances? I'm asking because of the leeway price spike compared to Thursday's spike having single prints. So I think what this person is asking, and this person can come back and let me know if it's correct or not. But they said I think that they're looking at the price the spike base, sorry, as a single price reference versus the spike itself as a range. That's why I think they meant why they said that leeway and acceptance area.
I'm
So really
sorry.
what the question is there a difference in the spike base and the spike itself? I think
No,
that's what the question is.
no, I mean, the spike is defined by the high of the spike, the base of the spike, and the spike itself. Notice here's the spike base right there. Notice yesterday morning, and here, if you were really looking at the market yesterday, it was very interesting. You single printed up in the morning very aggressively. You opened, you went down, you tested the overnight low, you couldn't get it, came back up, tested the low one more time, and then you got single prints. Notice that the single prints went to the base of the spike. So the spike, the market opened below the spike, it was quickly rejected. And then that was it, the spike base. Once you got above the top of the spike, you see you got another sharp breakout. So that spike was very meaningful yesterday in there. The volume for the first half hour trading yesterday, volume was the heaviest that I have seen in some period of time. It was probably 30 or 40% above what we've been seeing. That was a really important indicator yesterday, that volume was heavy early on. I told you the market was very aggressive early on. The single prints give you an idea of the aggressiveness of what's going on in the market. Once we got above the spike base, the market really started to accelerate. You got above the top of the spike, and then you got your next acceleration. That also becomes kind of a support level. The top of that spike becomes a support level if this market starts to give way. Okay, what else we got?
Okay, we've got questions related to the pain trade. If the pain trade discussed in previous webinars were some funds that were short on this rally, they may have to liquidate. Are we in the early majority, late majority, or laggard in that scenario is my question, or is that not possible to gauge?
I don't think you don't have any excess yet. So I think that I think you're probably in the, my guess was you're in the, someplace in the late majority. But remember, the real money is made in the market in the early and late majority. Sometimes the laggard can move very quickly, but I think that, that you can look at that kind of thing. It can be overdone, but I would say you remember, you're probably not completed. You didn't have any excess yesterday. You're very close to the 4,600 level, which is, kind of the magical number. Now, the other thing I want to mention is today, I believe today is the monthly options expiration. And sometimes that will add a little bit of additional volatility to the market. So overnight inventory is about balanced. The very prominent point of control says 22 wide. Good chances that gets revisited. If that doesn't, that's just an indication that the market continues strong. So as we get near the opening, first we commented there was no excess on yesterday's high. So maybe this means there was no completion to it, and the market is challenging that high with just a couple minutes before the opening. All right.
Yes, some other questions. Somebody was asking, also related to the pain trade, doesn't the pain trade infer they're selling volatility in puts and welcoming puts being called?
There's technical ways to be long and short, but no, the pain trade, you're overcomplicating it. What they do to exercise that and to experience that is something different. But that's really not what's really the bigger question here is relevant. I think what took place is that the longer time frame was underinvested. That's the long-term money management. They're getting squeezed. It doesn't happen very often. it happens short term all the time, but on the long term basis, doesn't happen. That's why I labeled the report a rarity. You want to think about this. You're not going to see it very often, but you will see it over your trading career a couple of times. Okay, final question.
If the recent move is now being fueled by longer term investors, do you expect these price levels to hold since it is longer term money?
You don't know at that case. I mean, it's hard to tell. What you have happen in here? Remember, you had at least what I think you were underinvested with the longer term money. The hedge funds, I think, were short, as I said earlier. And some of that covering is taking place in here. And you had the retail was long and the CTAs are long. So, it's hard to say, market, it's over when it's over. I know that sounds kind of, hollow, but trying to predict when it's there, when it's completed, that's kind of a losing game. Follow what's happening with the market. Follow what's happening with value. Follow what's happening with the trend. As I say, every day when I look at the market, I look at the daily. As soon as the market closes, I go and I look at the monthly in order to get a perspective of the market. Then I go to the weekly, then to the daily, in order to keep perspective, because it's very hard to lose that perspective. All right, let me just finish with, this was a heavy duty understanding of the market, discussion of the market. It exposes some of the weaknesses in market generated information. They're usually, the information is good, the trend is there, the value is there, but sometimes we overweight the underlying structure and the references, and I'm guilty of doing that. Nothing works all the time, but understanding that, one of the most important things that we talk about a lot is what doesn't happen is often as important or more important than what does happen. The fact that we have continually had some weakness in the underlying structure, but no repair or revisiting of that structure was informational. And if you think about short covering is kind of a high level panic situation. And short covering very often does not lend itself to nice, neat references and things of that nature. Okay, let me say thank you very
Jim,
much.
sorry, I just switched to my charts because yours
Okay.
weren't loaded up there. The one last question here, if I may, somebody's asking, are you now back in single tick increments?
Oh, yes, I am. Yes.
Okay. Is that something you did just recently?
Oh, yeah, a couple days ago.
Okay.
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 So don't forget, this was heavy duty, but to understand the market, you need a deep understanding of it. And that's really what we're trying to do in the educational effort. Remember, the next program we've got coming up is the 2nd to the 10th of August. That's our primer, which introduces you to, how we look at the markets. That's a starting point to see what we do. And then later in the fall, we will have an intensive. But let me say thank you very much. I hope you spend some time to examine what we do. Thank you very, very much. I know.
Okay, so I just wanted to go over a few things for some questions that some people had here. I'm assuming that they're newer. You can go to our website, jimdeltontrading.com, go to courses at the top navigation. That's where you'll see the primer featured up at the top. You can scroll down and you can get an idea of what we're covering, what types of things that we're covering each day for the 8 days. The schedule is also there if you want to download it. Times are posted in Eastern time. And then when you scroll down, you'll see our other course offerings. For those of you who are really interested in doing the intensive in the fall that's going to take place in October, you're going to need to make sure that you do the prerequisite requirement, which is the Foundation and Application of the Market Profile e-course. Without that, you cannot qualify to take a live intensive with us. For those of you wondering what's the difference between a primer and the Foundation e-course, feel free to type in any specific questions you have here right now, but I'll try to get to those questions, but I just wanted to mention that basically what we do to make the live market profile primer course a live course, we teach some of the linear teaching portions from the foundation e-course for the live market profile primer, and that's what we do the first 4 days. Obviously, the foundation e-course covers a lot more than what we can cover in a primer. So that's what the major difference is there. But basically, the first 4 days, we go over some of the basics that we teach in the foundation e-course in a live environment. You can ask questions. That's why a lot of people that do the foundation e-course first end up coming and doing a live market profile primer to make sure they understand some of those basics as Jim teaches it or as intended it. And then the latter 4 days, Jim narrates the market and provides live commentary when we're not in a live webinar, as well as daily reports like the one that you saw today earlier in the webinar, which is our form of homework. And so it's just that gives you an idea of all of the variables that come together and how Jim will evaluate and look at a market. So that's really what makes up the live market profile primer course. Now, with regards to questions here, yeah, somebody's just asking, is there a prerequisite course for the primer? No. For the primer, there's no prerequisite. If you're wanting to do the live intensive with us, you need to do the prerequisite course of the Foundation and Application of the Market Profile e-course. Okay, and also just to mention for those of you that are new, we do have a YouTube channel. We release a video every Sunday called The Week Ahead. So you might want to go and watch those or subscribe so that you've got access to that and also the correct channel. Our Twitter is also on our website. I just want to mention there's a lot of fake Twitter accounts that try to basically tweet what we say and make it theirs, and then they start sending solicitations and crap like that. So just be aware, be careful of that. We never solicit for that, obviously. Um, for the primer, do we need to have a or to market profile? You take that or the foundation e-course. Technically,
Jim,
you
you
don't
were
have to have
cutting out. I
market
don't know if
profile
people could
charts.
hear you.
Oh, I'm sorry. I'm not sure. Where did I start cutting out, Jim?
When you started talking about something just about a minute ago.
Okay, so all I was just trying to state is that in order to take the primer or the foundation e-course, you are not required to have market profile charts, and you are never required to use what we use for our market profile charts. What we would recommend is that usually by the time you take an intensive with us, you might really want to consider having your own market profile chart so that when we're not in a live webinar, you can observe the market. So like I said, for the primer, you don't have to have charting yet. And technically you don't either for the foundation and application of the market profile e-course, which is the prerequisite to be able to take an intensive with us. Okay, the next intensive is going to take place in October. We will make the announcement at the end of this month. So subscribe to our emails if you don't already. That way you can be aware when we make that announcement, as well as for those of you that have Gmail and whatnot, just an FYI, our emails may be delivered to your junk or spam folder. So if you've ever written to us, or if you have subscribed and you're wondering why you're not getting our emails or seeing them, it's probably because they appear in your junk or spam folder and you need to safe list us, okay? So that they're delivered to your inbox. Okay, I think that's all the questions that we have for now. We did record this webinar. It will get released once the processing of it has been finished. And somebody's asking, is it better to do the primer or the foundational e-course first? Okay, okay, let me explain this. And if you have additional questions, be sure to type them in. The live market profile primer is only done a few times a year. So if you happen to be lucky and see that first and want to do it as a low cost entry to figure out if you enjoy, you know, how we teach and how Jim looks at the market, then great. You start off with the primer. If we don't have a live primer available, then you would start off with the foundation and application of the market profile e-course if you know that that's something that you want to do. What I find is that people that start off with the foundation e-course usually end up taking at least one live primer whenever we have it, because it helps them to have that extra iteration and in a live environment, hear other people's questions and also have the opportunity to ask clarification questions themselves. Um, and if you're somebody who does the primer, then generally speaking, if you enjoyed that, you continue on to do the foundation e-course. So hopefully that answers your question. If there's any others, I'm happy to speak with you over the phone, or like I said, shoot us an email. Our contact information's down at the bottom of our website. Here's where you find our email. Here's our phone number. Okay. Okay. Well, everybody, I hope you have a great rest of your trading day, and see you next time. Bye-bye.